Welcome to Money Mindsets Matter. I'm Chad Craig, and remember, if money doesn't matter, then what's the matter? If you're not preparing, you're not prepared. Hey, I appreciate you being here with me. If you've not already subscribed, we'd love for you to do that. Hit the like button to be notified when we drop new episodes. And whether you're listening by podcast, we appreciate you giving us ear space and commute time. And if you're here, of course, on YouTube, we appreciate you as well. So we've been here in season 2 looking at, in my personal journey, infinite banking concept and understanding that a cash mentality is not the wisest way in dealing with our capital and answering the questions, where do I store, where do I put my cash, where do I store my money? And then also the question, where do I put it first? Where do I put it first? And we've looked at several things of a crumbling cash mentality and also a crumbling credit mentality, specifically from how I got introduced into doing this, which is through purchasing cars. And it's really important when you think about that because, you know, the majority of all Americans are purchasing cars. So we're looking at something that we're not asking you to do something new in your life. This is already something you do. This is something that you're already doing. Now, some of you are doing, or the way you're doing it, you're just doing it by default, meaning you've not passively asked yourself the question, like, what is best, the cash mentality, credit mentality? And what I'm doing the most efficient way long term to help me, or if you're married, to help your family, or if you're married with kids, to help family at large, or to think multi-generationally. And so we've been addressing and looking at that and asking these questions and looking at examples. But I do want to say that if this is your first time joining in as a follower of Jesus Christ, I want to make you aware that if your most important pressing need right now is not learning money mindsets or wise money habits, or how to take the banking function back in your life, or how to look at that, but you just want to know how to be right with your Creator, I'd love for you to check out my book, Divine Design for Discipleship. It's been out for many, many years and has blessed many people. And you can get that at Chad Craig Ministries at our web. But also we have me filmed teaching the curriculum that goes along with this book at Divine Design for Discipleship .teachable.org, where we have the online teachings of this, and you can find it there at the web. There's outlines for you to follow along as you see me teaching through it. So be aware of that. If that's your most pressing need, we want to make you aware of those resources. Well, as far as this podcast and this YouTube channel, Money Mindsets Matter, let's move forward looking at these questions of where do I put my money and where do I put it first? You're already answering them, but probably most of you are answering them passively, meaning you've not sat down and really thought consciously how you're answering that. You're just in default mode in what you have been taught, of what you've always known, what you've seen in your parents or grandparents or people growing up. And so we have encouraged you to take time to ask yourself those questions and to examine them in the light of some healthy money mindsets. And, you know, I mentioned before that when you start off in your 20s, 21, 24, you think, man, there's such a long track, a long road ahead of me. But as you get older, you start realizing that the Bible's correct, that our life is like a vapor. It's like a vapor. And if our need for capital is normally always greater than our access to capital, and yet our time trajectory is going down because our limited time here on earth is like a vapor, then how do we accelerate our access to capital, to liquid capital, to cash that can be used? How do we, in a sense, find a way to shortcut our access and liquidity of capital in a shorter time horizon? Well, that's one of the things that understanding a banking mentality does. And we're going to continue to look at that. It's a system that helps you get more access to capital, okay? Especially long term. The system begins to get more and more efficient and stronger over time. It has momentum. But this is why when we talk about a banking mentality, it's so important that when you begin to look into it, that you connect with a person like myself or someone else that understands how to specially design, okay, these specially designed dividend-paying whole life contracts with a mutual company. Because if you just ask the standard person about whole life or life insurance, they're not going to know how to specially design it to help accelerate your access to a greater liquidity pool than you have, okay? And over time, your system is going to be so much more stronger. You're going to have so much more access to capital and liquidity, liquid capital, money, than you've put in, okay? And so we've been talking about the foundational level of understanding infinite banking concept, of understanding a banking mentality. The foundational level in my journey was in purchasing vehicles. Up until I knew and discovered and was taught this, I bought every car since I was 18. Even when I was married, every car for my wife, I bought it with cash. In fact, one of the nice cars I bought my wife when we were missionaries in the Philippines and planning a church there in the Philippines, we were unable to sell it before we left to plant the church, and so it was still for sale, and I had a relative overseeing the sale and transaction of it while we were overseas. And so during that time, though, it got stolen, and that was a part of our journey as well. It was my wife's car at the time. So, but the foundational level is, look, we're looking at how this can be a blessing to you at a foundational level of something you're already doing. You're already purchasing cars. And so we're not talking about adding something to your schedule. We're not talking about you adding something to your life. We're talking about, is there a wiser way to engage with something you're already doing? And all of us are doing it at different time horizons. You know, the average person gets a new car anywhere from 4 to 7 years, okay? Some are less than that. Some do lease options. There's all varieties, but regardless of the time horizon, we're doing it, and we need to evaluate it through a healthy money mindset. And a banking mentality is the best way. And the numbers don't lie, and it proves and shows it. And that's where, in a previous episode, I ended saying, would you rather spend more for a vehicle, but in the end have control of more money, access to more liquidity, than if you spent less on the car? See, that's the power of a banking mentality, is that you can actually spend more on the car, but through a banking mentality and through creating this system that you can control, you end up with more money than if you were to pay cash for the car, or if you were to just finance it through a third-party financer, through a credit mentality. Okay? And what we're talking about, again, is something that I've done. It's also something that is proven, and it's proven because a banking mentality in this system is built on guarantees. It's not built on the market volatility. It's not built on economic volatility. It's not built on a bunch of variables. We're talking about a banking system to remove as many variables from the equation as possible. And that's why this is a foundation to create wealth, and wealth for you, wealth for your family, or wealth generationally. And it's also a place then, if you already have wealth, to learn about where you can store the wealth and protect it with guarantees, okay? And so it's built on guarantees. And I don't know about you, but when you think if time is limited and our life is like a vapor and we always have a greater need of capital than we currently have access to, then why would I not want to learn about a system where on buying a car, which we're going to do anyway, I can pay more for the car, but yet end up with more money as long as I have this system in place, okay? So the cash buyer thinks that they're getting ahead by paying cash, but they're not. And a cash buyer can never win the race against someone with a banking system or with a banking mentality and this system in place. It's not possible, okay? A cash person can win against a credit person, but not someone that has a specially designed dividend-paying whole life contract with the mutual company, especially rightly designed. They can't win against it. This is too powerful, too many guarantees, such a solid, secure foundation. And it reminds me of Jesus' teachings. You know, Jesus said when it comes to building things, you can build on the rock or build on the sand, meaning you can build on allowing everything you're doing and built to be vulnerable to so many variables. Or you can build on a foundation that when those variables and outside forces come, it's able to withstand it. That regardless of what happens politically or geographically or globally or in the finance system, you have this foundation for wealth creation and wealth preservation. Because in the end, these guarantees are there, and it provides a peace of mind. And it also provides actually more freedom to see possibilities and opportunities. And we're going to get to that if you'll stay with us on this journey, but that's why we're looking first at the foundational level. Because part of these guarantees is that we're looking and utilizing a company that for over 100 plus years has every year paid dividends. Every year paid dividends on these policies. That's through the Great Depression. That's through World War II. That's through the GFC, global financial crisis. That's through the pandemic. That's through all these different economical events. Yet these mutual companies that we work with have a track record of paying dividends. That's foundational level. Now, this leads us then, what makes it work? Why does this banking mentality or this system work? What makes it work, and why is it so distinct from every other asset class or every other choice that we've talked about in the previous season of stock market or CDs, different money market, savings vehicles, accounts? What makes this unique, and why does it work? Why does it work where I could pay more for the same car that you get as well, and you pay cash and I use my system? How can I, by paying more, still end up with more money? Well, here's why. Let's look at it. So let's say, excuse my big board this time, might help you see though, but let's say you put in your system $125K, okay? And that $125K that's went into your system has grown to $150K. Now, again, this is not legally designated or considered an investment. Okay. This is why this money also grows tax-free, because the government and the IRS does not consider this an investment. See, what are we talking about? We're talking about a foundation being put in our life for wealth creation and wealth preservation. So we're trying to remove risk. We're trying to remove vehicles. We're trying to build our life like on a rock that can withstand storms, withstand ups and downs of market, ups and downs of seasons of life, ups and downs of different variables we'll experience, to have a consistent foundation. And the reason this can happen is, one, we're becoming part owner of the mutual company, a company that has a track record older than you, 100 plus years. And not just a track record, but a track record of paying dividends every year. And the reason why I keep highlighting that is because by contract, dividends aren't guaranteed. But when you look at the reality of what the companies have done in their track record, they have declared dividends every year. Okay? So what that means is, contractually, we do have a guaranteed rate of growth. So in the contract, you have a guaranteed rate of growth on every dollar you put in. Okay? But you also get uninterrupted growth. And that's why this is foundational, because we're looking for guarantees and stability for wealth creation and wealth preservation. Or also stability in it answering a problem or something all of us are doing in life already, which is purchasing vehicles. Okay? And that's because contractually we have a guaranteed rate of growth that our money is guaranteed contractually to grow by, okay, with interest. But also it's uninterrupted growth, meaning the contract comes with the benefit of, when we put money in, it gives us access, or it becomes cash value. The money we put in gets turned into a value, a cash value. And let's say you put in 125, but now through the guaranteed rate of growth, uninterrupted growth, okay, and dividends, the cash value's grown to $150K. Now, it's time for you to purchase something you want. It could be a car, could be a loan for something else. And let's say that you're going to take a $50K loan. So you've put in your system 125. it's grown to be valued to $150K. This system gives you access to the liquidity pool of the mutual company. And you take $50K loan from that big pool of cash from the mutual company. Okay? Now, when you do that, when you take the $50K loan, your cash value, okay, the value of your system in that moment is $100K. That's what this lines represent. So the whole bucket represents $150K. You drop down because you took a $50K loan, meaning you would only be able to take another, normally can take up to right at 90%, sometimes a little more of the current cash value, okay, as a loan from the mutual company's pool of cash. So you would have, if this helps you visually to remove this, you would have left two-thirds of your cash value, so that would be $100K of the whole $150 bucket. All right. Now, this is why it works, and this is why it's so powerful, and this is why when people see it, they can't unsee it. And business owners and wealthy people who understand the value of access to capital and how money works, when they hear about it, do it, because it's so easy for them mentally to understand. When I ask you, though, in this scenario, okay, this $50K came out, by the way. This is out. And let's put you down here. That money came out, and let's put you down here. All right. So that $50K came out to you. When I ask you in this scenario, in this illustration, now again, there's no need to get hung up on numbers right now, because this concept, the reality of this works whether this is 250 and this is 350 and this is 100. You can change the numbers. It's understanding how this system works. But when I ask you in this scenario, what amount of money is still earning dividends and interest? What amount of money is still earning dividends and interest? Remember, you got $50K right here in your pocket. You can go use that. Maybe it was for a car, something else. We'll deal with all those later. But remember, banking mentality is getting the control back in your hands when it comes to banking and what you do with money. But what amount of money is still earning dividends and interest? Well, most people would say, well, my $125K has grown to be valued in a cash value in this system to $150K. Out of the $150K, okay, that gave me access to take a $50K loan from the mutual company's pool of cash. So $150 minus 50 leaves me with that 100. So most people would say, I'm earning dividends and interest while this loan is outstanding on the 100 in K. That would be the normal logic, but that would be wrong. This is why it works. This is the power of a banking mentality. This is the power of you starting now on building your system. Because the truth of the matter is that regardless of an outstanding loan, you are still earning the whole time dividends and interest for that full amount of the cash value, the 150K. That is how, and only how, you get the uninterrupted compounding growth in this system. See, remember, if you went and paid cash, the moment that cash came out of your whatever money market savings account, it's no longer earning anything. Plus, at the time of this recording, these systems are far out earning by a guaranteed rate of growth what money markets and savings accounts are offering in your normal banking institutions. So, but this is how you have uninterrupted growth. If your money was in a CD and the CD came to maturity and then you took that money out after the CD matured to go buy whatever, is it earning any more interest? No. No, because once it comes out of that vehicle, it's no longer earning interest unless you put it then back in a CD, back in money market. But this is the power of a banking mentality and the power of specially designed dividend-paying whole life contract with a mutual company, because it allows you to do this. And it's the only asset that allows this with guaranteed rates, okay? With guaranteed rates. So the whole time that you have that 50K and you're doing whatever with it, you still have the whole 150K earning interest and dividends, okay? Now, every dollar that you pay back from the loan, every dollar that you pay back into the mutual company, okay, pool of cash, every dollar you pay back of the loan, instantly becomes available again. Instantly becomes available again, where you can loan it out again. So when you take a loan, the amount of your cash value that's earning interest and dividends is not diminished or lowered. Okay? The only thing that's lowered is what amount of the mutual company's pool of cash you could take a loan for. Okay? But the amount that's earning interest and dividends, you're earning dividends and interest on the full amount of that cash value. Not the amount minus the loan. No. The amount that your money, your contract has now grown to. Okay? And that is the power of uninterrupted compounding growth. And that's the power of this system. So when that $50K loan, if you repay it, okay, it gets repaid, then guess what happens? Now you would have a full $150K of your cash value able to be collateralized over here if you so choose the next time. You would have, again, access to $150K of the mutual company's general pool of cash. That's the power of it. And of course, because the $150K has been earning interest and dividends, your bucket's growing every day. Every day, it's becoming a greater number than 150. Okay, which means then this is going to keep expanding as well, the amount that can be collateralized or access to the mutual company's pool of cash. Why? Because you're considered mutual owner. It's a mutual company. It's not stockholders. Every policy owner is a mutual owner of the mutual company and therefore has access to the general pool of cash. Now, when it comes to guarantees, again, the mutual company, because we're talking about a foundation of growth and a foundation for wealth creation and wealth preservation, the reason they're also able for 100 plus years to pay dividends, no matter what's going on economically, is because they're required to have on hand over 107%, sometimes a little more, cash-on-cash reserves for every liability that's outstanding. So what that means is if every liability, okay, so if every person who owned the contract were to die on the same day, the same time, they would have more than enough cash on hand to cover all those outstanding death benefit liabilities. So that, again, gives peace of mind. It brings guarantees. It removes risk. It removes variables for this system, okay, to be in our life, and then also as a mutual owner through owning a policy of the mutual company to engage in this money mindset. And this shows you why it matters, and it shows you the power of it. Because remember, no other asset can, when you collateralize or use cash, the value, when you take it out and still earn interest and dividends on it. Okay? Now, if you were to do that with your stock portfolio and take a margin loan, well, go see what happens in a GFC, a global financial crisis, a housing crisis, a pandemic, when people who have margin loans against their portfolio and the stocks tank, even if it's for a month, 2 months, when they get margin calls. See of what can happen. Why? Because they are engaging, or trying to engage in a system similar, a mentality similar, but without guarantees and without foundation, without peace of mind. They're entering risk. And we don't want to do that when it comes to the foundational level of wealth creation and building stability for ourselves, our marriage, our families, our homes, and generationally. Okay? So this is the power of it, friend. Lastly, on this episode, I want to show you what this that I just talked about, why it works and the power of it, what it then looks like within the car loan. And so if you've not seen the previous episodes, go look at them. But I would draw and show you, because this is how it first came across my journey in my life, as I saw an illustration similar to this, and it piqued my interest, and I leaned in and began to learn about Nelson Nash, and who discovered and termed and is accredited the infinite banking concept, and now his legacy continues with the Nelson Nash Institute. But I saw a video like this, and if you've not already, I encourage you to get his book, Becoming Your Own Banker, that helps you begin to interact and understand the power of infinite banking concept, okay, and how it can be used with this special asset of dividend paying, specially designed dividend paying whole life contract with the mutual company. But in it, we talked about that the black was a cash mentality. This down here was a credit mentality. And this is our banking. Look at the difference. The cash mentality, remember, you put in, store up, save in the savings vehicle. But the moment you take the cash out and go buy the car, that was the example that I've done personally, showed you. What happens? The account goes to zero. Save up again, just like I showed you in previous episodes. You can go see it. Take the money out to buy a car. Where are you at? Zero. So in the cash mentality, you always end at zero. Credit mentality, you start at zero, you take a loan through a third party, and instantly you go what? Negative. So we showed examples, negative 34,500, whatever. So you have the amount of the car plus interest, and you slowly pay it back, right? And we did 5 years here. This was 5 years, 12. You can go see it. Then you do what? Buy another car, take another loan. You drop down negative, slowly pay it back. And both the cash mentality and the credit mentality get you where? They only get you to zero. But a banking mentality, you start at zero, but watch this. You have contractual guaranteed rate of growth. So your dollars are guaranteed contractually to grow at a certain rate. This is what it looks like. See that line? It's just going up. But it gives you so many other benefits. The dollars you put in, okay, get turned into another bucket, okay, called cash value. And the cash value amount determines how much of the general account of the pool of money, the pool of cash, the mutual company that you're part owner of, that you can collateralize and take a loan and utilize anytime at your discretion. And that's what this represents. So your money's growing contractually, but you use your system, and let's say you take out a loan. Okay, so the amount of cash value that you can use in the moment drops down. But every time you make a payment, every dollar you pay back instantly, the cash value you have available to use, to collateralize and take a loan in the general pool of cash of the mutual company, instantly goes up again. See, and when that loan gets paid, look at this. Your money never stop growing compounded. Take another loan, boom. You never, ever even get close to seeing zero with your money. Your money, look, that's what this line is. It's growing nonstop. Now here, this visual helps you understand that even if you didn't take a loan, this line would still be this line because your money's contractually growing. Interest, and then dividends declared every year, growing with interest and dividends. But the power of this banking mentality and system is that when you collateralize this and buy a car, take a loan, whatever, you end up at the same place as if you didn't even take a loan. That's not the case here, because both of these you end up at zero. This one you end up where contractually your money was guaranteed to grow anyway. Now, would your money grow this rate whether you took a loan and bought a car or not? Absolutely. Absolutely. So this is not the more loans you take, the more your cash value bucket and your liquidity and access to capital is going to increase. No. This is you have access to liquidity pool and can use money, but it doesn't diminish the growth of your money and your access and the value of that money through cash value long term. That's the power of this. Okay? Now, that's the foundational level. We can take you to the transformational level of what Nelson would say is that there's ways that if you want to be a good banker, that when you pay back loans, you add additional money to that loan. So when this gets up here, it bumps this actually up higher. Okay, which I'll show you in episodes to come. Okay, but in the example I showed you at the car, I didn't talk through any of that. So this just shows you that the power of using this system, your money is growing the whole time, but yet as it grows, you have access to use money to go buy things. And when you pay it back, you have full access, okay, to the value of that money to be loaned against, again, anytime you so desire, all right? So that is what? This is the vision of uninterrupted compounding growth at a guaranteed rate. A banking mentality, and neither of these can beat this system. That's why it works. That's the power of the concept, okay? Of the concept. And so I hope that helps visually. I look forward to seeing you next episode. We're going to talk creatively some ways to help you. But again, this is Money Mindsets Matter. I'm Chad Craig. And remember, if money doesn't matter, then what's the matter? If you're not preparing, you're not prepared. We'll see you next time. God bless you.